Well, good afternoon, ladies and gentlemen. I should say good afternoon to those of you who are joining me on the East Coast. Good morning to those of you who are in the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. Excuse me. I also want to say good evening to those of you who might be joining us from across the pond in parts of the UK or parts of Europe. And, of course, good early morning if any of you are joining us from parts of Australia or parts of Asia as well. Welcome to today's presentation. What we're going to do today is, instead of our standard introduction to Power Options presentation, we're still going to do an introduction to Power Options, but today we're going to focus on the weekly options, how to use the Power Options tools for identifying the weekly options. These are not necessarily new products, but we do receive a lot of questions from new trial members, new subscribers, asking, do you have the weekly options and how can I identify weekly options? Well, today we're going to do a course on how to use the Power Options tools for weekly options, as well as some strategy discussion as well on the common strategies used with weekly options. Well, before we begin, we always want to start off these presentations with just identifying what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools allow you to search across the universe of options to identify only those positions that match your stock and option criteria, and we do support over 23 different option strategies. After you've identified the position, you can quickly compare the risk versus reward, do further research and analysis on the stock and on the options combinations as well. In addition to that, we also have a powerful set of portfolio tools to help you paper trade, track, and manage your positions. We'll be able to take a look at that later on this afternoon or later on this presentation as well. In addition to that, we do offer countless educational articles and help pages to help you get better acquainted with the tools on the site and the option strategies that we support. We've been in business for over 15 years, but everyone here at Power Options, including myself, use these tools for their own research and analysis. So we have many more years of combined trading experience here on staff to help you not only with the tools, but the different option strategies and management techniques as well. For those of you that do not know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerenner and the Power Options staff for the past 10 years. I handle a lot of the coaching sessions and a lot of the education on the site. I have co-authored 2 books on investing with Ernie Zerenner, one on naked puts and one on protective option strategies, different forms of married puts and collars. And I always want to be upfront, I am versed in all the strategies that we do support on the site. However, there are certain strategies I have never traded in my personal account and probably never will. These are things such as the iron butterflies, short straddles, short strangles, of course, and naked calls. These strategies don't match my personal risk-reward tolerance, too much risk involved or too much difficulty trying to pick the exact strike price in the case of an iron butterfly or an all-call butterfly or all-put butterfly. So I don't trade those strategies in my personal accounts. However, if later on you do have questions about those strategies or how to use tools for those strategies to identify the weekly options at the end of the presentation, we'll be more than able to answer any of those questions as well. Okay. Well, today we're going to talk about weekly options. What are weekly options? Well, essentially they're just regular options. And they're standard options. They have the same requirements and obligations as the regular expiration series, just in a shorter time frame. The idea is, of course, that this can increase your annualized return. I say potentially, because although that if I sell a weekly series week by week by week, I'll probably generate a higher premium than selling the static option that expires on the 3rd Friday of the month. But I still have to be right on the direction of the stock for the strategy I'm trading, otherwise I'll still suffer losses. It's not an immediate guaranteed extra profit, but it does have the potential to increase your annualized return. And there's a lot of flexibility with the management on these positions. A lot of you might have traded covered calls in the past. Let's say you sold a series that was maybe 2 months or 3 months out in time and found the return that you wanted, and as the stock moved up, you looked to roll the position. But as you looked at the adjustment opportunities, you noticed that your option that maybe is 70 days out in time, the only series you can roll to is maybe 130 or 140 days out in time. So there's not, anything in between, and you're kind of stuck in a rut. So you really don't want to go maybe 140 or 180 days out in time for the next series. Well, the weekly options give us the flexibility of nearer-term management as the stock moves with us or against us, so we can try to lock in more profits or potentially generate more premium or prevent a large loss by rolling to a different cycle. There are a limited number of securities that offer weekly options, and the first thing we're going to do when we get into the Power Options tools is we're going to run a basic search just to identify the total number of securities, stocks, ETFs, and indexes that offer weekly options, so we have that as a base point. The weekly series technically expire on, oh, it says 4 p.m. Why did I do that? I apologize, folks. It's technically at about 8 p.m. I'm sorry, on Friday. Well, we know that the 4 p.m. on Friday is the last time we can trade them. But for your standard expiration, the standard third Friday expiration, they technically expire Saturday morning. That's when the Options Clearing Council comes in and clears out all the options and everything's taken care of. It's usually Saturday morning. The weekly options, gentlemen at the CBOE told me that they technically cleared out of your account Friday evening by around 7 or 8 o'clock. That is, of course, with the exception of the AM settled options. Some of the indexes offer AM settled options as well. Brief history of weekly options. On October 28, 2005, the SPX, the S&P 500 index weekly options were released on the Chicago Board of Options Exchange. These were cash settled just as the regular SPX options. According to my research when I went back in time, in 2006, more weeklies were added for the OEX, it's the S&P 100, of course the XEO, the XSP, and then later on the Dow, the DJX, excuse me. June 4th, 2010, so 4 years later, we saw weeklies available on some of the standard ETFs, of course, SPY, Cubes, DIA, and IWM, which was the Russell 2000 ETF. And on June 25th, 2010, roughly 20 days or so later, the first weeklies were available on the common stocks, Apple, Bank of America, British Petroleum, and Citigroup. And then, of course, after that, they expanded further on. The availability of weekly options. The new series are released at market open on Thursday. This presentation, I will admit freely, we wanted to share the weekly information with you because we had several questions come in this week about identifying weekly options. But this webinar, I'll be honest with you, is probably best done on a Thursday or Friday when that new series is available. But that's okay. We're going to use some of the historical tools to see the week 1 and week 2 series. So Thursday morning, the new series released. At that time, you'll still have the current weeklies open. The weeklies that will expire that Friday, 2 days from Thursday morning, technically. And the new weeklies that are available are 8 days out. And these are usually marked as week 1, expire in 2 days, and week 2, that technically expire in 8 days. That is, at that time, Thursday morning is the maximum number of weeklies available at any time. Now, let's just talk briefly, a couple slides here on the typical strategies for weekly options, then we'll jump into the tools there. One of the standard rules of options is that when you're buying options or you're doing long strategies, you look to buy options that are further out in time. And the reason for this is it gives the underlying more time to move in your desired direction, and the cost per day is lower when you purchase further out in time. Yes, the upfront cost is higher, but the option with the same strike on the same security that's 6 months out in time is not going to be 6 times the cost. So you talk to any long call investor, long put investor, many of you know I follow the radioactive trading techniques with opening any position as a married put. We're looking to buy options that are maybe 5, 6, 8, 10 months out in time. Yes, we're paying a higher cost for that insurance or for that long call security speculating on a market movement, but it's because we want to give time for the stock to move in our direction and our cost per day is lower. Also, when we're doing long series, we don't see that rapid time value decay. The time value in option usually happens in the last 30 days. So when we're buying options, we want to go further out in time. I bring this up because when using the weekly options for buy strategies, it's not recommended. You can trade them, but we don't typically recommend it. Things such as buying long calls, buying put options, doing the long straddles where you buy a call and a put at the same strike price, or strangle where you're buying a call and a put, but they're different strike prices, whether the call's in the money and the put's in the money, or the call's out of the money and the put's out of the money. Recommended way to do married puts, the radioactive trading techniques. Not recommended to use weekly options for buying the put option for insurance because it's a rapid decaying security and it's not giving you enough time for the stock to move in your direction. Same thing with married calls. If you go short stock and you buy a call for insurance, you wouldn't want to be buying a weekly call against your short stock position because it's just too short a time frame. That being said, for these strategy positions here, these insurance positions, married puts and married calls, I have talked to many investors who will be in maybe a dividend-paying stock that offers weekly option. They're long on it. They have a fair amount of shares in their account. They've been building it over time. And as they get within 1 week or maybe 10 days to an earnings event, they may buy a weekly option if it expires after that earnings event, just to have a low cost of insurance for the next 10 days. And if the earnings tend to disappoint and the stock collapses, they at least had an insurance policy in place, and they didn't really pay that much for it because of the shorter time frame. But if I'm long-term bullish on a position, I don't want to buy stock and then buy a weekly put option if it does offer weekly options, because it's just too short a time frame. Okay, so what are the recommended strategies? What are the strategies that are more commonly used by investors to do weekly options? Well, the vertical spreads, the bull put and bear call credit spreads. There's, of course, some caveats with those, and also the debit spreads. Iron condors and butterflies, those are used also. Some investors will do covered calls and naked puts as well, and of course that means the reverse, doing covered calls and naked calls. In general, many of you know that at Power Options here, we don't recommend naked calls as a long-term growth prospect because they do have infinite upside risk potential. But these income strategies that were selling premium, which decay more rapidly with only 7 days, 8 days to expiration, these are the more favorable strategies that are used, that are used with the weekly options. Now also a little bit later on, we're going to talk about some of the unique opportunities that are available with collar spreads and calendar spreads, diagonal spreads, for example. If you're not familiar with a diagonal spread, let's just take an example of a diagonal call spread. I may buy a call that's 6 to 7 months, 8 months out in time, or a leap option that's in the money. So we have a stock trading at 50. I might buy a January 2014 45 strike call. Right? So I might pay $12 or $15 for that position. At the same time, I might sell a November 50 or 52.5 call, maybe collect 50 cents, $1, $1.20, something along those lines. And the idea is that I'm treating that in the money leap call as sort of a stock ownership, synthetic stock ownership. Instead of buying the stock and doing a covered call, of course, we're using the leap call, paying less premium. Now, it's always recommended that when you're doing a diagonal spread or a horizontal spread with the same strike, that the option you're buying is at least 3 or 4 months out in time. If your stock happens to offer weekly options, something that's unique that some investors were looking at is simply buying only a 2-month out option and then trying to sell the weeklies against it. So that still almost gives me 8 write cycles, meaning I can sell a weekly call against that 2-month out call week by week by week each month and almost get 8 write cycles before the 2-month out expirations. That means I have a lower debit because I'm paying lower in the position. Now I do have a shorter time frame now, only 2 months for the stock to move in my desired direction, but I'm still able to squeeze in maybe 6 to 8 write cycles using the weekly options. And some of the dynamic collar spreads are used in that fashion as well. We'll talk about that a little bit later on when we get into the strategies themselves. All right, well, all that being said, let's go ahead and navigate over to the Power Options suite of tools. And the first thing we want to do, we want to get a benchmark there. And what we're going to do is we're going to run a basic search in the naked put menu. And what we're going to do is just identify any security that has an option that expires 2 days from now. So it's standard weekly expiration, 2 days from now on Friday. Just one strike out of the money, so we're not seeing duplicates. Now, of course, I don't have, from our last webinar we did, I don't have naked puts available in my tab, so that's okay. Let's go to other strategies. And for the time being, let me go ahead and remove long call, and I'm going to go ahead and add naked put into my available strategies. And let's go ahead and save that. Okay, so we're going to customize our strategy tabs there with the other strategies menu. Now let's go into naked put. Click right on that. It'll take us to the strategy homepage. Excuse me, folks. And what we want to do now is go right into the search tool. All right. So anytime you're in a strategy and you click on the main search, it's going to pull up a series of listed trades for you. These are not recommendations or suggestions. These are just the trades that match our default criteria. Now I'm going to do something basic first just to get the total count, but then we're going to start from scratch again. We're going to talk about some of the rules I use for identifying weekly positions in any search. And we're going to play around with a few different searches. We'll get to that in a moment. But what I want to do right now, let's scroll down to the very bottom. Below the listed trades, we have the parameter field, and in every strategy, you'll have about 15 to 20 different stock criteria and 15 to 20 different option criteria that you can use to identify only those positions that match your requirements. What I want to do is go all the way down to the bottom, and we're going to click Clear these settings down here in the bottom right-hand corner. I want to remove all of the criteria from the default search. We're going to start from scratch. So when I want to create a weekly search, the first thing I do is I go to the option expiration time frame. I'm going to select all months. But then underneath that, I'm going to use the days to expiration field, and I'm going to put in the days to expiration to be between 2 to 9 days. And we'll talk about this a little bit more when we run a basic search. Now, in this search, what we're doing is we're just trying to identify only those positions that offer weekly options. We only want to see one strike out of the money. So I'm just going to put in my range. We have show in the money, show out of the money by number of strikes or percentage. Well, I'm going to put in the number of strikes 1 to 1. So I'm only seeing one strike for every security that has an option that expires between 2 to 9 days from now. Let's go ahead and submit those settings. Let's see what we've got. Okay, something is not right here. That is interesting. It only showed 5 results, but we know that's not correct. Let me try this. Let's go, I apologize, folks. Let's go 3 to 9 days. I know what I did. I apologize. My fault. Okay, something, I don't know why this isn't working. I think I have some other setting here that's hidden. Give me 1 second, ladies and gentlemen. Let's go to Apple real quick. Do I have to do 4 days out? No. See there, I'm sorry, we just went to the chain, and we do have the weekly series here, the 2 days left, so that should be coming up in our results because there's no other criteria. Let's go back. I'm sorry, folks, this worked 10-15 minutes ago. I don't know why it hasn't worked now. Let's try that one more time. Let's clear these settings so everything is out. I'm going to go all months. I'm going to keep that at 1 to 9 days. Wow. I'm not sure what just happened there. I might try another strategy real quick, but that shouldn't make any difference. There we go. I'm sorry, folks. Oh, it's because the 2 days out. I was wrong. I'm sorry. There we go. All right, so what are we looking at here? When we're looking at the first 25 results, the first 20 results, and we have 169 total results. So that tells us that there are 169, can't speak English today, 169 total results. But actually, I do know, just off the top of my head from what we saw before, that there's actually only 164 because there were some series that are 7 days out that we saw with some of those ETFs and indexes. So those already have series that are released for the morning expiration. So let's narrow this down to just be between 1 to 3 days. And that should give us our 164 count. Okay, so little glitch, we're back on track. Fantastic. So we have 164 stocks, indexes, and ETFs that offer weekly options. Now, we can see that there's a mix here. On the first page alone, we have some standard stocks, Questcore, Green Mountain Coffee Roasters, for example, but we also see some of the ETNs and ETFs, the VXX ETN, the Exchange Traded Note, FAS, the Direxion Shares Financial Bull 3 times ETF, and the Small Cap Bull ETF TNA is there as well. We also know we'd see FAZ in some of the later pages, and as we mentioned earlier, we'd see SPX, DJX, and so forth. Well, let's take our total count now, and what we want to do is we're going to scroll back down to the parameter field, and in every strategy, of course, in the center section, you have a selection here where you can select a recommended list. So we can choose only to screen against things such as the IBD 50, S&P 5-star list, S&P 500, or indexes and ETFs. Well, right now I don't want to search just against indexes and ETFs. I want to use the lower field. We're going to remove the indexes and ETFs from our results. Let's go ahead and click Submit these settings. So we had 164 total securities. Remember, we only selected one strike, so we know we're not seeing duplicates. And for just the stocks, once we remove the indexes and ETFs, we have 127 standard stocks that offer weekly options right now. And of course, if we wanted to switch this, we can just do the simple math. We know that there would be 37 indexes and ETFs that offer weekly options, but we can choose to view that. Let's select No List from our Remove list, and now in our recommended lists, we're just going to select indexes and ETFs. Let's go ahead and click on Submit. And there we go. So we have our total down at the bottom now of 37 indexes and ETFs. Okay, so there's your total count, 164 securities, 127 standard stocks that offer weekly options, and 37 indexes and ETFs. Now, Before we go any further, I'm going to launch just one poll, and what I'd like to know is, even if you're doing the buy strategies, I just want to know what types of options strategies are you trading or are you researching right now. Better way to phrase this is maybe, since you're joining us for the weekly presentation, the presentation on weekly options, I should say, what kind of strategies are you looking to maybe implement with the weekly options? Covered calls, the protective option strategies, married puts and collars, vertical spreads and condors, of course long calls and long puts, or maybe time spreads, the diagonal spreads as well. So just let me know what strategies you're looking at. Okay, let's see here. All right, so I've got most of the votes in. We're going to leave this poll open for about another 15 seconds, and then we'll turn that off. All right, let's go ahead and shut that down or close the poll, share the results. Pretty even split here. 38% of our audience is doing covered calls and naked puts, and that's a tie with the vertical spreads and with the long calls and long puts. Okay. And then we've got 25% of you doing the protective option strategy and 25% doing the time spreads, the diagonals and the verticals, the calendar spreads, for example. Okay. Well, since we're on the naked put screen, let me start there. And we'll switch over to covered calls. We'll discuss some of the basic rules that we like to use for these strategies. And then, of course, we're going to spend time on the vertical spreads. We're going to spend time on the maybe some of those time spreads, the calendars, and those dynamic collars I mentioned. And, of course, we'll talk about the long calls as well. Okay. So we saw earlier, we went into the naked put tab. We went into search. There's a default search selected for us. It was the initial value search. But to create this basic weekly spreads, weekly search, so we just had the total number of securities that offered weekly options, we started off by going down to the bottom and hitting clear these settings. This is the same process I will do if I'm creating a new weekly search in any strategy. The reason why is I want to start off with the most basic criteria that I would be interested in the strategy, because the weekly options have a much smaller premium. We know that. Yes, we're offered a better annualized return, but we have a much smaller premium to begin with. And we, of course, also have smaller returns to be expected. So let's create our weekly search. I'm going to do the same exact thing. We're looking at a naked put screen, so I'm going to want stocks that are bullish. I'm going to want to generate a minimum premium. And I'm going to have a basic line of what I'd want for my minimum return. For me, that is the starting point. I don't want to put too much in. As simple as it sounds, that's the starting point. First thing, again, set my days to expiration. For this presentation, we're going to do 1 to 3. Okay, so we're just looking at those weekly series. Now, let's pause for a moment. When you're going to create a search in any of the strategies that you're going to use to identify the weekly options, I recommend that you go back to that default criteria I started to use before. What I was having an issue with is earlier this morning I was looking at it before the market opened, and I was running the scan from 2 to 9. That was working perfectly fine. Why didn't it work now? Well, because technically there's only 2 days to expiration, so that 2 days to putting in that number of 2 was forcing all of these out because the computer's looking for greater than 2, and 2 is not greater than 2. In any case, the reason why I always set my weekly searches for an expiration time frame of 2 to 9 days is because when I'm looking for new positions for the weekly series, I'm typically looking on Thursday morning. And so when I put in this field of 2 to 9 days on Thursday morning when those new weekly series are released, putting in the value of 2 filters out the options above that are going to expire in 1 day. I don't want to see the 1 day out options. You can screen for those if you want to just trade a 1 day security Thursday morning. That's perfectly fine. But I'm looking for to open the new series. I'm looking for that new series that was just released. So I want to filter out the ones that expired this Friday, look for the ones that expire next Friday. And why am I putting the 9 in there to cap it? Well, as we mentioned in the beginning slides, Thursday morning when that option is released, it technically has 8 days to expiration. So I want to include that, but I want to exclude anything that might expire in November on the regular expiration cycle, for example, or October. I should have said October for the regular expiration cycle as well. Okay, so that's why I use 2 to 9. Now, when I'm selling a naked put, we know that we're going to have to, let's say it's a cash secured put, so I know right away that based on my account size, I may only do a covered call or sell a naked put on stocks that are under $70 or $75. So that's the simple thing I'm going to put in first. This doesn't apply to the credit spread, but we'll talk about that in a little bit. So I'm going to put in my stock price range of 5 to 75. I'm selling a naked put, I want to be slightly out of the money. Normally, if I'm looking at a standard expiration, I might look for a range out of the money, a percentage out of the money of at least 5 to 7%. With a weekly series, that might actually be too far in most cases. And what do I mean by it might be too far? Well, an option that's 7 or 10% out of the money that expires in 2 or expires in 7 days, for example, in that new series, that might not have any premium. We might be talking about 2 or 3 cents on a $30 stock or a $40 stock. That might be too little premium for me. So I have to narrow down. I have to bring down my expectations of what I'd use in a normal search in any strategy. So I'm only going to look for 2% out of the money. We're, of course, going to be hindered today as well because we're just looking at the Friday series. We can run a historical search from last week, last Friday, for example, to look at the 2 to 9s. We might do that as well. I'm sorry, the week out options that were released. All right, so with any income strategy, myself personally, when I'm looking at covered calls, opening a new naked put position, opening a new vertical spread, especially now that we're in earnings season, I always like to check the box down here for earnings date not between now and expiration. I will always verify that when I'm running my search, when I have my results to see when the next earnings is, but I want to kind of narrow that down. I don't want any surprises over the next 5 or next 7 days, for example, or in this case in the next 2 days if I'm in a position such as a naked put or covered call where I'm still risking effectively 97 or 95% of what I invested in the stock. So I don't want any sudden surprises that might result in a 30%, 20% unrealized loss. Okay, now basic return, our naked yield, well, we're only 2 days out, so let's keep this small at 0.5%. If I'm running this search on a Thursday morning for the naked puts, I'm going to try to look for a yield of maybe around 1% to start off with, just a percent naked yield of 1%. And my option bid price, well, let's look for at least 10 cents. And in some cases, we only have 10 days out. I'm sorry, 10 days out. We only have a couple days out here to the Friday expiration. So let's just put in 10 cents. Maybe I should lower that to 5 cents. But let's submit these settings and see what we get. Okay. Well, that's not too bad. We kept it simple. We just put in a few basic criteria. We know we're looking at the weekly time frame. We want to be slightly out of the money. We want to try to avoid earnings dates. We want a basic minimum yield. We knew our stock price range, so if I'm doing covered calls, of course, or a naked put, a cash secured put, I might not be doing anything that's on a $100 stock, $150 stock. So we put in our stock price range and a minimum option bid price. That alone narrowed down our results to only 27 securities. So this is a good, manageable list. But I see a couple other things in there. Here's the crude oil volatility index. There's the VXX again, the ETN, that exchange traded note. I also saw, I believe, up here, just the standard volatility index, the VIX, of course. Naked put available on that one with a yield of about 2.8%. Well, for doing naked puts, we're doing cash secured puts, and we only want to do them on the standard stocks. We want to avoid some of these ETFs or these 3 times ETFs especially. General rule of thumb, I tend to avoid those if I'm looking at weekly series because they are so volatile. Can they result in good profits? Absolutely. Can they swing against you quickly and result in larger than you wanted undesirable losses? Absolutely as well. So I tend to avoid personally the leveraged ETFs with these kind of situations. But let's just narrow this down further. We're going to do the same thing that we did. So if you're only wanting to look at the standard securities, the standard stocks, well, with a weekly naked put, just scroll down to the bottom, go to that remove stock list. Let's plug in indexes and ETFs and click submit these settings. Okay, and that takes us down to 18. It's a very manageable result. Now, before we go into some of the other strategies, what's my next step? Well, I am sorting these results by percentage naked yield. Any of the filters that you can use in any strategy to identify a position you can choose to sort by. So if I wanted to instead sort by the annualized naked yield, if I wanted to sort it by the percent to break even, for a naked put, that kind of equates to the downside protection in a covered calls trade. The static percent if unchanged, you want to sort it by time value and so forth, you can choose to do that. Here, let's leave it at naked yield, and we see right now that the Quest Core, Q-Core, is at $20.09, $20.09 current underlying stock price. We're shown an opportunity where we might be able to sell the 2-day out October 19.5 put for 40 cents. Well, this would result in a 2.1% yield for 2 days. It's pretty reasonable. That's going to be a very high annualized percentage return, but we also can't assume that I'm going to get 2% every 2 days because my next series won't be available. Well, the series that comes out tomorrow If I ended up trading that on Monday, that would only have 5 days left, so I'm not getting 2.1% every 2 days. I'm averaging closer to maybe 2.1% every 5 or every 6 days. Okay, well, this is the highest yield. Is this the one I'm going to jump into? No. In any strategy, you still want to do your further research and analysis. And on Power Options, what we'll use is the More Information button over here on the left-hand side. And the first thing I'm going to do is take a look at charts. And I'm going to go to Big Charts. And you, of course, can customize Big Charts any way you want to and have it store your settings. I don't have that here. But what am I doing? In general, we're talking about a naked put position. It's a neutral to bullish position. I want the stock to stay the same or move up in price. I want my put to expire worthless. If I'm interested in the stock long term, sure, I can use the naked put as a means, or the cash secured put as a means to buy shares of stock at a discounted price, maybe convert it to a covered call or a collar position with protection. But what I'm looking at here is I want to take a look at the chart. That's the first thing, and say, okay, well, it matched that base criteria that we came up with, but is this something that I would trust for a naked put position? And we're not going to talk a lot about charting and how I analyze a chart, or different things such as the MACD, for example, or all of that. What I'm looking at right here is just this. I don't have to go very far back to say, wow, here and here, this stock is pretty volatile. It has some big drops. I don't like pharmaceuticals myself anyway. But this is probably not a position that I'd feel comfortable with selling a 19.5 put if I saw this type of decline again, this almost 60-70% drop in the stock price. I don't want to get stuck with 60 to 70% unrealized loss on my naked put if something like that happens again. So I'm just going to close the chart, and I'm now done with QuestCore. And I'm not even going to look at anything else in that More Information menu. I'm not going to look at the news, the company information. If I'm not comfortable with the chart, we're just done with that stock. I'm going to move to the next one. Okay, here's VierNet X Holding. Never heard of it, VHC. Let's take a look at the stock chart. We'll take a look at big charts again. This looks similar, doesn't it? Well, it's not too bad. It's rebounded, pulled down, so maybe I'm not comfortable with this. Okay, let's go to First Solar. I haven't looked at that one recently, but I'm just going to grab this, see if this is a chart that we may consider. I know a lot of things have pulled back recently. We've had a bad market, but let's take a look here. Let's say, okay, this stock has fallen, kind of rebounded off the bottom. It's been moving up, had a little glitch there, but it's been kind of stable here. Maybe if we're selling out of money, looks like there's support right there at around 20 or so. So let's take a look at that First Solar position. It, of course, is the October 22 days away. It looked like there was recent support there. It's a 1.2% yield. Now, originally, someone who trades naked puts or covered calls might say, oh, well, I want to look for yields of 2% or 3%, or trading a covered call, I was promised by my guru that I could make 3 to 6% per month. First off, that's not realistic. Second off, we're talking about weekly options here, so what you'd expect on a standard expiration cycle, you've got to almost cut down, divide by 4, so sometimes even divide by 5 for what you would expect with a weekly series. So a 1.2% yield in 2 days, that is really good if it works out the way you want to. All right, so let's say I went through my first 5 stocks, and First Solar was the stock chart that I liked. Am I going to go ahead and trade it? No. I want to take a look at the company information. I'm going to take a look at the news, the earnings events, the profile. If I'm not familiar with what they do, I want to take a look also at maybe the last 30 days or maybe 2 months of headlines, see if there's anything that might cause me hesitation to entering this position. Any rumor about a boardroom scandal, changing the CEO, a pending patent lawsuit, or a pending lawsuit of any kind against the company or against the board. I want to know that before I go into the position. All right? And then, of course, the next thing I can do is, for those of you trading covered calls and naked puts, what I do at this point, after I've looked at the company information, the stock chart, of course, the news, the information, I'll take a look at the earnings events, the last earnings as well. What I might do now is link to the option chain. And what I want to do with the option chain is it's going to pull up the series, the different series, the standard I'm sorry, folks. Hold on one second. There we go. The standard expiration and the weekly expiration as well. So now that I've looked at the chart, we know that the 20 strike put option was on our results, about a 1.1, 1.2% gain. It's highlighted in red for us as a quick marker of which option we were looking at. This is a 5-strike put chain. But I can also compare now the naked yield. I'm sorry, naked yield's over here. I can also compare the naked yield to the 20.5. So now that I've looked at we saw that the 20 came up in our results because it was at least 2% out of the money, had the return that we wanted. But now that I've looked at the stock chart, done my information and research and analysis a little bit, now that the stock is trading at 20.80, okay, maybe I feel that the stock's going to stay at that price or move up to 21 for the next 2 days. I don't think it's going to drop below 20.50. Maybe I can be a little bit more aggressive, get a little bit more bang for my buck. So instead of getting 23 cents for the 20 put, maybe I can get 41 cents for the $20.50 strike put, which would give me a yield of 2% for 2 days. I have to realize, of course, I'm closer to at the money. That's why the premium's enhanced in that case. So I have to be probably more watchful of this over the next few days with the stock trading at 20.80, and I'm looking at the $20.50 strike. Or if you still like the security but maybe you want to be a little bit more conservative, you can compare the ratio here of going to the 19.50. Now again, that's a 0.7% yield, so it's much lower. So it's about half of what we were looking at with our 20 strike put. But remember, it's 0.7% potential naked yield for 2 days. So that does give us this exaggerated, for lack of a better term, the exaggerated percent naked yield annualized. We're not going to be able to do this every 2 days because we're not going to have a series that expires every 2 days. The average is probably going to be closer to 5 days when trading positions in a weekly portfolio. Okay, so that's just some of the research and analysis that we can do there, going to the option chain to compare the other strikes. I would do that in a covered call or in a naked put. And of course, when we get into the credit spreads in just a moment, we will talk about the using the search by symbol tool instead of the option chain for those strategies. At any given time, of course, we can also do detailed research into the stock or the option. I'm just going to go into the option research tool here. And the stock research table or the options research table gives you all of the available data and some of the calculations that we have for the stock or the option. But on the option table, what you also have is this historical view. And what we're showing here is the historical view from when the option was released. So this only goes back 5 days because this First Solar weekly option, the 20 strike put, was only made available on October 4th. Last Thursday morning. That's when the option was available on the exchanges. So here we're just looking at the change in option bid versus implied volatility as a default. The black line is our option bid. The red line is our implied volatility. And of course you can change that if you wanted to compare it to the stock price, for example, the option volume, implied volatility we already did. I'm sorry, we're on that right now. The percent not assigned, the ask price, the open interest, and so forth. The time value maybe versus stock price, or time value maybe versus implied volatility. You can get down into the nitty-gritty with that research as well, but it only show you the data for when that option was released. And as we know, our weekly series that we're analyzing weren't available until Thursday morning of last week, October 4th. Okay, so we'll come back to this. What I'm going to do here is I'm going to quickly save this search. So I'm going to scroll down to the below the parameter field. We're going to click Save, and we're just going to call this weekly search, October 10th. Basic screen for weekly options. All right, and you want to keep things simple, remember, just because of what's available, the premiums that are available, and so forth. Now the covered calls, let's save that search. We're going to come back to this in a minute. We're going to go through the next steps. We're basically done, identified some naked puts. We showed kind of what tools I might use to further research and analyze the position. Now what we want to do is very quickly, I'm going to go into the covered calls, and we're going to do the same thing. Okay, so let's go into the covered call search. Well, basic covered call search, nothing matches our criteria here. Well, that's okay. We're not using that search. We're going to create our own, starting from scratch. Again, go down to the bottom, hit clear these settings. It clears everything out. Set our option expiration time frame to all months. Normally, as you know, we'd put in our fields for 2 to 9 days for when we're running our Thursday morning search, or even if you run searches on Friday or Monday, you want to use that range of 2 to 9 days. We're going to expand on this because we're in between the new cycles. The new series won't be released until tomorrow. So I'm going to put my days to expiration 1 to 3. But remember, 2 to 9 days is what you typically want to use. Okay, covered call. Well, if I want growth, I might go a certain range out of the money, just like 0% out of the money. In general, though, if I'm doing a covered call in a weekly series, I probably want to be right at the money to maximize the time value. So what I'm going to do is use a restriction here. For percent in the money, I don't want to go more than 2% in the money, and I don't want to go more than 2% out of the money. What other basic thing am I going to do? Well, we're always going to double check this when we start researching our stock, looking at the earnings, verifying the earnings. but I'm going to select now to narrow some of my results because I don't want any surprises. We're going to check that box for not between now and expiration. What might we basically look for in a covered call? Well, we know we're buying stock. So again, you know your personal portfolio. I know mine. I'm going to keep that same restriction for stock price as we did with the naked put or the cash secured put. I'm going to put in 5 to 75. Downside protection. This is essentially just the option bid price divided by the stock price. If I'm looking at a normal standard expiration that expires on the third Friday, let's say it's the Monday following a regular expiration, I'm looking 1 month out to open an October series if it was September, or if it's after October expiration looking in November. I might look for a downside protection with an at-the-money covered call of maybe 4%, 3 or 4%. I'm considering a weekly series now, so I got to narrow this down to maybe 0.5%, and I'm doing 0.5% because we only have the series available that expires in 2 days. Normally I might look for around 1%. And I'm going to do the same for the percent if assigned. So if the stock is trading above my call strike price, I want to make at least 0.5%. And again, when I'm doing the covered call, I know how many shares of stock on average I trade. Maybe it's 100 shares, more likely it's 400, 500 shares, maybe trade 1,000 shares. But based on what your commissions are and what share blocks you usually trade, that's going to dictate for you what is the minimum option bid price that you want to see. Now, I want to collect at least 10 cents in this case. Okay? You're going to have your own criteria, but we're just walking through the paces. So that's all I'm going to put in. Something very simple. I'm not putting in any fundamental or technical criteria right now. You want to start off with a very basic screen of minimum return, minimum option bid price, what range you'd be in or out of the money, maybe avoid that earnings date between now and expiration, and for covered calls and naked puts, what price range are you looking for? Simple weekly series. Keep it simple weekly search. Keep it simple to start. Let's submit those settings. Now, if I happen to run this search and I have 85 results, that's good and bad. What's great about having that many results is now I can go in and say, oh, well, in addition to what I just ran on that screen, I only want to see stocks that are trading in an uptrend, maybe that are trading above their 50-day moving average. I only want to see stocks that have an average stock volume of maybe 750,000 shares traded per day, or maybe 1 million shares traded per day on average. Once you run your basic search and you see which results you have, you can then fine-tune using the fundamental and technical criteria to really narrow it down to just those stocks you'd want to see and those weekly options you want to use as well. Well, for this particular search, it does look like the puts were slightly more inflated than our calls were, but we only have 3 results, so I don't want to filter any further. This is a good manageable list for me to start doing research and analysis. In fact, it might be too few to open it up. We had more in the naked puts, so the implied volatility on the put options might be a little bit higher based on the last 2 days of activity, or really today, I should say. But we've got some choice here. AT&T currently trading at $37. Hey, we were looking for at-the-money strikes. You can't get any better than that. The at-the-money October 37 call, 22 cents. So this would result in a downside protection of 0.6%. and a potential percent if assigned of 0.6% as well. Again, we do the same process. What am I going to do now? I'm going to take a look at the stock chart. Let's see, is this a position, or is this a chart? Is this a stock movement or stock momentum that I feel comfortable for a covered call trade, even though it's only 2 days away? I want to be in a neutral to bullish position. I don't want something that can snap against me. Then we'll take a look at the company information, take a look at the last month or so of headlines, see if there's anything that might cause us hesitation. Review the profile, take a look at the earnings and events. We could delve deeper using that stock research or option research tool. Covered calls and naked puts. We can take a look at that option chain. I want to see what other strikes are available, which might still give me a decent yield. We know they're not matching our default results, but we can at least see why isn't the, let's say there's a 36.50 for AT&T, why isn't it giving us that minimum 0.5% we were looking for? Or maybe do we want to go a little bit out of the money, or maybe we're a little bit more bullish over the next 2 days? Okay. And then, of course, again, for the other strategy, we'll use search by symbol. We'll talk about that in a moment. So you just want to keep things simple to start with. You want to open this up. Let's say you're not happy with only these 3 results. You want to open it up a little bit more. Well, you're not going to change your stock price. You still want to be at the money. And naturally, we're not going to change our days to expiration. So what I'm going to have to do, I'm going to have to lower my expectations here. Let's try a 0.3% downside protection. A 0.3% if assigned, maybe only an option bid price of 5 cents instead. Let's submit that, see if we get a little bit more than 3 results. It's easy to be overly restrictive when doing these weekly series. No, how about that? There's still only 3 results there that match that default criteria. I'm going to open it up a little bit more. maybe go a wider range. Let's try that, shall we? Let's go 4% in the money, 4% out of the money. See, it's trial and error. Just change one filter at a time to either open your results more, expand your results or your search results, or restrict them further based on what we have. Still no go. Let's just collapse everything, shall we? 0.1%, 0.1%, and 1 cent. You see how tricky this gets? Of course, we are in that awkward time frame where we don't have the full weekly series available, won't be available until tomorrow morning. So we're only looking at things that are 2 days out in time. Nothing. A lot of low premiums available, a lot of things there that aren't matching our criteria. This, of course, could be hindering it as well, not between now and expiration, because we are in an earnings cycle. All right, so quick pause. We are at 12:45, but if you have any questions about the weekly search or using the weekly search for naked puts or covered calls, go ahead and send that in, and we'll take a look at some of those. But while I'm waiting for those questions to pop up, let's go on over to bull put credit spread, and let's just talk about that briefly. Again, not to sound like I'm beating a dead horse here, but with the credit spreads, we're going to follow the same principles. We're going to keep things very simple when creating a weekly search. But instead of focusing on the underlying stock price, we're going to focus on the maximum risk level. Okay, so let's go into search. And again, as we know, we're going to see our default results come up, or the results here that match that default criteria, but we're not going to be starting with that. Let me scroll down to the bottom here. We're in bull put credit now. I'm going to clear the settings. What's our first step? Hey, change our option expiration time frame to all months. Put in a days to expiration of 2 to 9 days normally, remember, but we're changing that today because of our time frame that we're in. Next time we run one of these weekly webinars or a follow-up to this introduction to Power Options for weekly options, we'll do it on a Friday, or we'll do it on a Thursday perhaps. We have both series available. All right, well, we're going to put this 1 to 3 days. I still want to be out of the money. Okay, so just as we did with the naked put, I want to start lower. I'm going to go at least 2% out of the money for the bull put credit spreads to start. Well, I'm going to look for a return as well. We have a minimum return we might be looking for, so for my leverage bull put credit spread, we might want a minimum return of 3%. I know many of you might try to look for that 12% return when you're looking at a standard series, or maybe 15%. We're doing a weekly option. You can't expect to be 5 or 10% out of the money with an option that expires in 2 days and still make 12 or 15%. If those are out there, this tool will find them for you, so you don't have to try to do all the combinations manually. It'll help you save time with that, but you shouldn't expect it. Minimum net credit between the two puts. Well, remember, if we were only looking for a 10 or 15 cent net credit on the naked put and a bull put credit spread, we might be selling that put that offered 10 or 15 cents net credit. We got to buy the other put as well to sort of hedge our downside here. So let's go ahead and put in a minimum net credit now. We got to expect that lower. We're going to keep it at 10 cents, okay, to start with, because we are, again, only 2 days out in time. Now, I'm not going to put in anything for these fun criteria that we can use that options investors love to use, the open interest or option volume. You typically won't have to worry about high volume or high open interest for the weekly options. They're heavily traded. But if you have a requirement, hey, plug that in. Implied volatility, not going to bother with it. Black-Scholes ratio, not going to bother with it. Short option delta, long option delta, not going to bother with it. I am, again, going to check that box over on the left-hand side for earnings date, not between now and expiration. And I'm not going to worry about a stock price this time because I'm not buying a stock. But I'm using margin, so we're going to have a spread. But if my preference, for example, is that I only want to trade 5-point spreads, or let's say dollar strike spreads, 2.5-point spreads, or 5-point spreads, I don't want to do the 10-point spreads. Well, I can filter that by using the maximum risk, or simply over here on the left-hand side, we have this strike difference field in our credit and debit spreads. So what I might just set is I want to see strike differences that are less than or equal to 5. So I want to see 5-point spreads. Now I can put that in the maximum risk as well. The maximum risk, of course, is defined as the margin requirement, the difference in strike prices minus the net credit. So no, I'm looking for 10 cents, but I'm looking for a 5-point spread. Well, if I set my maximum risk to be less than 5, that will essentially do the same thing as the strike difference we just did. Okay, nothing else. Not putting anything else in. Let's go ahead and submit that. System's now going to look at all possible bull put combinations. Okay. Here's one of those ones, 81 total results. Now, in general, many of you know, you've heard me in other webinars, when I trade I do trade bear call credits and bull put credit spreads with maybe about 10 or 15% of my portfolio, but I typically only do it on the broad-based ETFs and indexes. I'm not saying there's anything wrong with doing the bull puts on the standard stocks. You just have to watch them more closely because they are more volatile. Now, I am inundated right now. We do have 81 results, but I can see right away that I'm inundated with these bull 3 times ETFs, the FAS. I got some other FAS, and there are a lot of combinations. They're single strikes. So we've got the 108, 106 combination, 108, 106.5, 108, 107, 108, 105. These single strikes sometimes drive me nuts. There's so many combinations. There's a whole bunch more down here as well. We've also got the VXX in here, the Volatility Index ETN, the Exchange Traded Note. But remember what I said earlier. I might be okay now. I'm not going to limit it to just stocks. I'm okay using some of these ETFs that are in here. If IWM came up, for example, or the Cubes or SPY, I might be okay doing a bull put or a bear call credit spread in weekly series with those. But I don't like, myself personally, I really don't like these leveraged ETFs. So I'm going to scroll back down to the bottom. I'll remove stock list field. We're going to do that again. But instead of removing just the indexes and ETFs, I can choose to remove the inverse ETFs, but really what I want to do is remove the leveraged ETFs. I want to get rid of these ultra short, ultra long, 2 times, 3 times bull and bears. So I'm going to remove those from my lists. Just go ahead and submit that. All right. So the ETN is still in there. The Exchange Traded Note, the VXX Short-Term Futures Volatility Index is still in there. That's okay. But we took out about half. Okay, we narrowed our results down to 40. Well, what else can we do? Well, what are some of the things we talked about? Now that I have these results, I maybe want to narrow it down to just a couple dozen. We'll use our other filters that maybe we wanted to see. So, for example, one thing is we're looking at a bull put credit spread. I want a stock that's in an uptrend, so maybe what I'll do here is use a simple moving average and use the stock price to be greater than the SMA 50. If I was in a bear call credit spread looking for weekly series, I might reverse this and I'd look for the stock price to be less than the SMA 50. But we're in a bull spread here, so we're going to look for stocks that are trading above their 50-day moving average. Let's go ahead and click Submit. And this cuts us down to 18. Well, the way the market's been behaving today and how it behaved a couple days ago, that shouldn't be surprising. The VXX actually dropped out, but we do have some other positions. Cliffs Natural Resources here, the 39.5, 38.5 combination with a 22% return. Hey, there it is. You know, I said if there's something that matches your criteria that for 2 days might have that leveraged 22% return, this tool will find it for you. So it's, we're looking at a net credit of 18 cents. Yay. It's a weekly series, though, so that would equate, 4 times that. That would put us around the 72, 75 cent range for a standard series, so that's acceptable. And, of course, our maximum risk here would be 82 cents because it's a dollar difference. We're looking at a dollar strike difference now, but we're collecting 18 cents in credit. Okay, so that's how we would do the bull put spreads. Let's start off simple. Again, put in your time frame, all months, 2 to 9 days. Put in a lower expectation out of the money, maybe 1% or 2%. We're starting with the naked puts or the bull puts or even the bear calls. You'll have that field as well. My preference, earnings date not between now and expiration. Minimum return, minimum net credit. Start off with a very low value, maybe even still want to match your expectations. Okay, I don't want to tell you to trade something that's below your expectations or your goals for the given weekly series or a given month series. But start off with something low. And then just run that search. Of course, then for the spreads, we can do the strike difference or the maximum risk there. Run that search. You have 80 results? Hey, start putting in your other criteria. Maybe look for something with simple moving average. For the spreads, probability. We know we're going at least 2% out of the money, but maybe I want to make sure that I have, let's say, at least a 70% probability that the stock, in this case, the stock or the security would remain above my short put, and the puts would expire worthless. The theoretical probability, let's put that in. Click Submit these settings. I bet you that first result's going to be gone, that Cliffs Natural Resources. No, it's still there. I love making a liar out of myself. How about that? All right, so this still has the probability we want, 73.2%, 18 cent net credit. This is not a recommendation or suggestion of what to trade. We're just going through the steps here of how to use the tools. And just as we did with a naked put and covered call, same process. Going to use that more information button. Going to take a look at the stock chart. Is this a position? Is this a chart that I feel comfortable entering into a bull put spread that I feel is neutral to bullish over the next 2 days or in a regular series, maybe the next 8 days, next Friday expiration on Thursday morning. I'll take a look at that company news and information. For those of you that are spread traders, there's 2 tools that you can use. Let me step back and make something a little bit clear here. When we ran the searches for the naked put, for the covered call, and here in the bull put credit spread, what we're seeing effectively, this net credit, is the worst possible scenario. Now, there's not going to be a lot of bid-ask difference on the weekly options, but what I mean by the worst possible scenario is we're showing you the natural bid price for the option you're selling and the ask price for the option that you're buying. But up here at the top, we have a spread chain tool, and when you're researching your positions, remember how I said how I might want to compare this to the other strategies. Let's say I did like Cliff's resources, and I've got 2 here back to back, and looks like there's 1 further down. But if I wanted to compare these series, what I may simply do is just go to the midpoint spread chain or the search by symbol. Let's talk about the midpoint spread chain very quickly for those of you doing the credit spreads. What this tool is doing, I got to narrow this down here. What was our minimum return? Spread width was 1 in that case. Minimum net credit, hey, let's put that back down to 10%. Out of the money range, 2. I just have to tweak some of these very quickly, folks. That's there and that's there. Let's submit that. There we go. There's some of our spreads. Here's the, you can see here, it would have come up for us, but here's the spread that we linked to. It's highlighted in red for us, again, just as we saw with the option change, so it's a marker of which spread we were looking at. Over here on the left, we are seeing that we're looking at the weekly series. We can expand it to the standard expiration if we wanted to, or we could go out to November, but for right now, we're just looking at the weekly series. Okay, so let's erase that for now. Okay. But what we saw here is that it didn't change much, did it? It changed a little bit, actually. Remember, our minimum net credit we saw in the search using the natural bid and the natural ask had us at a net credit of 18 cents. Here, on the midpoint spread chain, we see that we can increase that to 22 cents. Okay, well, you say to me, well, that doesn't sound like a big gain. Well, when we're trading weekly series and we're talking about a 4-cent increased credit by using the midpoint pricing, if you can get filled at that, that's going to take you from that 22% return to a 28.2% return. And of course, you know, it's very hard to use the annualized returns here when we're comparing the weekly options because you're not going to be able to get 28.2% every 2 days. Remember, the next series that's available is going to be 6 days out, so really you'll be averaging maybe this return every 5 days, which is still phenomenal, but it's not a guarantee. Remember, things can still go wrong. I'm going to click the little plus sign here next to our 38, 39.5 bull put spread, and that's going to expand it. So for the put that we would be selling, that 39.5 put, on the search page, we were looking at the natural bid of 40 cents, but the ask is at 44, so our midpoint is 42. And we were looking at an ask price of 22 cents on the search tool for the put that we're buying, the 38.5 put, and but with the midpoint 18, we can get 20 cents. So there's our 22-cent net credit from 18 cents. So if we did get the midpoint pricing on a spread, we're going to be a little bit better off here. Increase 6% return, increase by 4 cents of potential credits. That midpoint spread train, whether you're doing vertical spreads for weekly series or whether you're doing for the standard expiration, it's a very useful tool, and it really gets down into the specifics of what you'd want to see. This is done 1 stock at a time. But as you run your search to narrow down to which combinations match your criteria, when you're doing those spreads, you can link here, and you can take a look at that as well. Very quick, for a minute or so, I'm going to talk about the, let's see, what was it? Protective and time spreads. I'm going to talk about the collar spreads. I had mentioned there's some unique opportunities with the collar spreads for weekly series. We're going to take a look at that, and what I'm going to show here is going to apply as well to those of you doing the diagonal spreads. We now have 2 different time frames we can use, so it's really simple. We want to follow the same process. We want to keep the search simple, but at the same time, we want to make sure we're in the right time frame. Let me scroll down below our listed trades in our collar view. This is looking at a default for conversions, but I don't want to do that. I'm going to scroll down to the bottom and hit clear these settings. Now, let's treat this as a calendar spread idea or as a collar. If I'm doing a dynamic collar or calendar spread, let's talk about the calendar spread. We talked about the diagonal. I'm going to buy an in-the-money call that's maybe 6 to 8 months out in time and try to sell near terms against it. But we can kind of adjust that time frame if we're looking at weekly series. And in relation to the collar, what I might be doing is still trying to sell the weekly call week by week by week. But instead of buying a put that's 6 months out in time for long-term protection and slightly out of the money in this case with a dynamic collar, maybe I just want to go 2 or 3 months out in time, as I would for the diagonal spread. So with the weekly options, I don't have to necessarily go 6 to 8 months out in time with my long call. I may only go 2 or 3 months out in time. Now, that's what's possible. Can you still buy, of course, a call that's 6 months out in time and trade it weekly now, sell the short-term call week by week against that 6 to 8 month out call? Absolutely. In fact, that's probably encouraged because remember, your cost per day will be less. But again, let's do this as a dynamic collar. But we would do the same thing in the calendar spread. If I went into the calendar spread, scroll down to the bottom, hit clear these settings. And now I have 2 expiration time frames to deal with. For the collar, I have my short call. And what are we going to do? We're going to do all months, put in that 2 to 9 days, but remember, because we just have the Friday series available now, we don't have the second week series, we're just going to put 1 to 3, so we're narrowing it down to just the weekly series that expires on Friday. And my put expiration time frame, all months, okay, I'm going to leave that as well. This is the long put I'm buying. If I was in a calendar call spread, I'd have the near call expiration time frame and the far call expiration time frame. So let's try that. Let's do our 2 month to 3 months out. Let's go 55 days to 105 days. So it's, essentially 60 to 90 days, but let's give it a little bit of room of breathe. 55 days to 105 days. Call expiration date, you don't have to do that because we've already narrowed that. You could select the call expiration date to be less than the put expiration date or equal to, but we're forcing it already. Now, when doing a standard collar, a dynamic collar, or a calendar spread, my short call, so the call that we're selling in the calendar spread, you see near call. Well, I want this to be at least at or slightly out of the money, so I'm going to put call percent out of money 0 to blank, dynamic collar or a calendar spread. For show out of the money put, well, we know we're going to want it out of the money if I'm doing a diagonal spread or one of these dynamic collars. Start off with, rather than forcing it, my put to be a certain range out of the money, let's just go that the call strike has to be greater than a put strike. And again, I'm going to avoid the earnings date between now and expiration. I'm going to want to verify that when I go through my process, but we're going to do that for now. Okay, starting off for the dynamic collar, the net premium, this is the difference between the short call and the long put. I can't look for a positive premium here. In this case, when I'm buying a put that's further out in time, it's always going to have a higher price, so I'm not going to look for a positive net premium. I will, however, want my call bid to be at least 10 cents. Okay, so the call premium I'm collecting a call bid, I want that to at least be 10 cents. Now, my maximum risk, if I'm using a collar for insurance, I always keep my risks to less than 6%, less than 6.5%. Really, it's less than 7%, but for this example, I'm just going to put my percent max risk less than 6.5%. And hey, my maximum return for the first series, I might want that, again, keep it simple, minimum 0.5%. And my percent if unchanged, I'm going to want that to be at least positive. So if the stock stays at the same price between now and Friday, I want to make sure that I'm at least collecting positive premium based on the potential decay on the put, the premium I receive for the call, and the stock price. All right, well, that was basic. Put in our time frame, want the call to be out of the money. Hey, in this case for the dynamic call, I want the call strike to be greater than the put strike. Want to collect at least 10 cents for the call bid. Going to keep my risk to where I'd want. Hey, if I'm trading a collar or a protective position, I'm focused on the risk there. I know what my range is, so I'm going to put that in. And also my max return. Oh, by the way, we're looking at a dynamic collar. What's the other thing I have to do? I know my price ranges, so let's put it 5 to 75. I know my portfolio size. I have to buy the stock here in this standard collar, this dynamic collar, looking 2 months out for the put and looking for the weekly series. Let's see if we get any results. It's still a basic search. We're just looking for basic return. Ooh, many a combination. Oh, I see pro shares ultra short. You knew that was going to come up. I'm not going to invest in these. We've already talked. I'm not going to beat a dead horse, but I'm not going to invest in those leveraged ETFs. So let's go ahead and remove those as well. It's not going to take a lot out, but it'll take some out. Okay, leveraged ETFs. Oh, sorry, folks. There we go. Submit that. All right, so we started off with that simple search. So I just wanted to show some examples here. We're just narrowing it down based on our time frame. Remember, the 2 to 9 days out in time is what you want to start with when you're looking to open up new positions. Okay, so we've got a lot of collars here, a lot of dynamic collars. We see some Januaries. So most of them are selling the October weekly series. Let's take a look at SLW here, stock at 39.18. You can sell the 40.5 call for 11 cents and buy the December 40. It's almost at the money. Sorry, almost at the same strike price for 3.25. So it's got a debit of 3.14. Maximum risk is $2.32 or 5.5%. The max return, if the stock's trading right at 40.5 on weekly expiration, including the potential put premium, would be 1.9%, and my 0.2% if unchanged. Narrow it down further? Sure. What are some of the other things we can look for? We could try to look for that stock price. You know, bullish, dynamic collar here, standard collar, neutral to bullish position. We want the stock to stay the same or move up in price. Same with the calendar call. Let's put in my simple moving average there. Let's run that, see how we narrow it down. We were at 135 dynamic collar combinations. Narrowed it down to 101. So now I could use things such as the average stock volume for the underlying security. We can increase our percent if unchanged or our max return there to see a little bit better view. Okay, so that's what we're going to do. Let me go back. That's what we do with this strategies. Any search you want to create, keep it simple to start with, clear the settings, put in your time frame. Okay, usually going to use 2 to 9 days. Select all months and then put 2 to 9 days in there. And then just put in some of the basic criteria you'd use in any strategy. Let's go back to the naked puts here. One last step. Actually, we're going to do two things. Here's what we're going to do. I'm going to go back to the search, and then I'm going to trick you. I'm not going to trick you, but we're going to do something fun in the last 5 minutes. We're only going to be on for another 5 minutes. I know I'm going past our 1 hour time slot here. I just want to do something real quick. Here's our results again. We saved our search. Remember, there's that weekly search, October 10th, very basic search. And the first solar position is still there. The orders changed now as the markets have moved up and down and the yields have changed. But that first solar strike, the October 20.5 strike, is still there. What if we took this criteria we just created and ran it last Thursday on October 4th? Okay. And the reason why I'm going to do this, we're going to actually look at a position. We're going to pick a position from those results from last week. We're going to put it into the portfolio. After we've run our search in any strategy, we've gone through our steps of doing the stock chart. We looked at the company information, the news, the profile, maybe did some detailed stock and option research. On the naked puts and cover calls, we might go to the option chain. The other strategy, we'll use the search by symbol or the midpoint spread chain, what we just saw with those spread positions, to compare other strikes and combinations, midpoint spread chain especially, to see if there's any more bang for our buck using the midpoint, and that might dictate what our limit orders would be when we want to place the position. Of course, you also want to take a look at the profit and loss chart. It's a really dynamic tool, the profit and loss chart or custom spread tool, so you can see the graphical profit and loss of your position, and then you can run some what-if scenarios as well. But now, once I've decided that, I'd go ahead and place the trade. If you're using Options Express or Brokers Express, on Power Options, we link to Options Express and Brokers Express, so you can use the broker link there once you set it up. But if you trade a different broker, that's okay. You just go and place your trade, but then you want to come back to Power Options and you want to add the position to the portfolio. And the reason why is as you're tracking positions in the portfolio, whether they be covered calls, naked puts, calendar spreads, collars, standard collars or dynamic collars, or the vertical spreads, as you're tracking the position in the portfolio, you'll be able to link to a position analysis screen which will show you potential rollout opportunities. So it'll have calculated for you what your new potential return would be if you bought to close your put and sold a higher strike at a different expiration, you know, maybe the standard October expiration, which we could take a look at, or the November expiration, your new naked yield, your new cost basis, all that would be calculated for you. You can see it numerically, but then you can also compare it graphically as well. And we're going to do that, but what we're going to do, the position we're going to put in is actually going to be a position from last week using this search criteria. So let's go back test underneath the naked put menu. And I'm going to go Smart History Excel. Well, we know strategies in naked put. What is my search date? I want it to be October 4th, last Thursday when the new series expired this Friday were released. And my save search, well, I've got a few in here, but we want to run it using the weekly search October 10th that we just created. Let's go ahead and submit that. We might have a lot more results than we thought because there were more premium last week during the weekly series. Okay, so we're having the results come up now. Take a quick drink. There we go. So we're only showing you the top 15. These are sorted by naked yield, but we had 100 results. Okay, so If last week we ran this basic search we created, stock price of 5 to 75, minimum bid price 10, out of the money 2, no earnings, 1 to 9 days out in time, for example. Well, in this case, what I really would have done is done this search, 2 to 9 days out in time. That might narrow some of them down. Sorry, but just with those basic searches, when we ran the screen, if we would have run that screen last Thursday when the new series were released, we would have had 100 results. What is that? Well, that's too many. So this is a point, again, where we would have started to put in those other criteria, okay? And we can do that right on the historical search. We're going to tweak that to say, okay, well, I would have wanted to look for stocks that are trading above their 50-day moving average, or maybe use a field where you're looking for the 50-day moving average to be above the 100-day moving average. So we'll put that in. Remember, we already took out the indexes and ETFs. We were just looking at the straight securities for the weekly naked put screen. Well, looking at those, I may want to make sure that my position, my underlying security has a market cap, an average stock volume of at least 750,000 shares per day over the last 90 days. Now, this is measured in thousands, so I just have to put in 750. So we're tweaking this search a little bit. What am I doing? I just wanted to make sure my stock's in an uptrend. I want to make sure that I have some good volume here, just narrowing it down. I am seeing the top 15 results now. That alone cut it in half. Now we would have had only 49 results. Why are we only showing you the top 15? Well, because once you save your search, you create the search the way you wanted to, I chose to sort it by percentage naked yield, so these would be the first 10 or 15 I was going to focus on anyway with my research analysis. I don't really care about the 40th trade on the list that had a naked yield of maybe 0.5% when I have over 15 or 20 that have a yield above 1%. That's where I'm going to start focusing on first. Now, sure, I might not have selected these. Oh, this is a good example. This is a fantastic example. Let's go ahead and run this. While we're on the First Solar discussion, our top result, high yield, on last Thursday, October 4th, First Solar was at $22.55. We remember where it is right now, right? It's at $20, so this wouldn't have been a good naked put. But our search result had us a very high yield, 70 cents for 8 days out in time, a 3.2% yield for 8 days. That is fantastic. Of course, when some things are too good to be true, they probably are. So we could have sold the October 22 put against First Solar for 70 cents. Okay? Why is that important? Why am I happy about that? Because we're going to have a good example. Let's do that. What I'm going to do now is, when we were in the other screen, on the standard search, we could have gone into add to portfolio. I don't have that available here from the historical view, but that's okay. We're going to put it in manually. FSLR October 22 at 70 cents. All right, so I'm going to go into the portfolio. And from the portfolio tools, we want to go into the profit and loss portfolio. That's where we track our open positions. And let's just, see, I have something here, position adjustment. No, this will be fine. This will be fine. Let's do position adjustments here. We're going to enter a new position. So I'm going to select strategy, and I'm going to select short put. Short put or naked put. Okay, that's what we're going to enter. All right, so we have to select our option. I'm just going to click the select option button here. Needs to know the stock symbol. If I linked over from the search tool, all this information would be filled in except for my commissions, if I'm going to record any of those, and the number of contracts or number of shares. But we're entering it in manually, so the system doesn't know which stock we're looking at. So let's put in our stock symbol and click Submit. There's our chain. Now remember, we were going to sell the October 22 put. Last week on October 4th, we identified the October 22 put, selling at 70 cents for a 3.2% yield. Let's plug that in. The October 22 weekly put, let's keep the math simple, folks. I know it's only one contract, so it'll only be $70, but let's go ahead and plug that in. We're just going to do one contract, change my transaction date, of course, because I would have done this on October 4th. Price, 70 cents. Commission fee, this is a paper trade, so it's 0. Stock price at time of trade, we can plug that in. It was about $22.55, if I'm not mistaken, is what we saw on that historical screen. Now let's submit that. We submit it. It's going to link us back to our profit and loss portfolio. Here is our naked put or our short put position. Okay, it's organized by category. 3 long stocks in this portfolio, this paper trade portfolio, 1 married put, which is going extremely well for us, and 1 covered call positions. This was, for example, last week with a customer who had gotten into Sarepta at 1670, sold the 580, sold a 12.5 call for 580. called me up. It's actually pulled back now, but called me up after the stock gapped up to 42 and said, what adjustments are probable? Well, when a covered call position gaps up that far, just let it get assigned early. He did get assigned early, but just let it get assigned. Take your, in this case, I believe it was a 12% return. Be happy with that, and don't try to spend $28 or $30 to buy to close that call and then roll to a higher strike. Anyway, what are we looking at here? We're looking at our naked put that we sold. Would have sold it last week for 70 cents. What do we want to have happen? Hey, the stock needed to be trading above 22 at expiration. We wanted the put to expire worthless. Realize that 3.2% yield for 8 days. Clearly, that is not happening. The stock has gapped down, and it's going to cost us $1.27 to buy to close this put, or we're going to be forced to buy shares of stock at $22. Well, what are our choices? Well, I could do nothing, and assuming the stock stays below 22, let the stock be put to me. So I'd have a cost basis of $21.30 on 100 shares of stock that's now trading at about $21. Right? Not too bad. What are my other choices? Well, I could potentially roll this put to another series to try to minimize the loss, or roll it down and strike if I didn't want to be put the stock at this time. I could just close it as well and take right now what would be a loss of $57 or 2.6% of the cash secured capital. All right, but what are we going to see? First step, are there any adjustments? Well, let's go ahead and use that more information button in the portfolio. Go to position actions. This is where we'd edit the position. We can roll the leg if we know what we're rolling to. This is where we choose to expire the leg, or if we got assigned, if we're tracking a stock, we're adding a dividend. This is where, in the more information menu under position actions, that's where you do all of that activity. Close the position, roll the position, and so forth. But I don't know what I'm rolling to yet. Let me go to position analysis. Let's see what's available. We know we're down 57 cents on our put. We sold it for 70 cents. It's now trading at $1.27, so we have 57-cent loss. We have 2 days left to expiration and 0.8% time premium remaining on our put. Well, I scroll down, and there's my loss. What we saw in the portfolio there, I have a loss of 2.6% if I liquidate right now. If I hold it to expiration and the stock stays at $20.97, excuse me, in 2 days, we'll be put the stock and we'll have an unrealized loss of 1.5%. Not too bad. What are some of the rollout opportunities? Well, this is what I meant by flexibility. And if I check this position in the portfolio tools tomorrow, tomorrow after the market opens, if I looked at this put there, I would see choices to roll to the next weekly series, to roll to October. Actually, I apologize, folks, the next weekly series is already available, isn't it? Forgive me. The series on the 19th, technically right now, every optionable stock, index, and ETF has an option that's going to expire next week because it's the standard expiration. But we could see opportunities for October as well. In any case, this is showing us some potential adjustments where we could roll the put down, but it's also showing us here, check this out, this is showing us, assuming that we got the stock put to us. Since our put is in the money, we may be forced to buy shares of stock also. We'll still keep the premium, but we could convert this to a covered call, and it's showing us the return. So if I did get put the stock at 22, based on that price and the premium I received, it's showing me the calculations of what a covered call would look like if I converted it, now that I own stock, to selling the November 19 call, the November 20 call as well. And then, as I mentioned, in addition to seeing this numerically, we can also see it graphically. So I'm going to go to Simulate Trade. And here we have our original naked put. Right now it's currently a loss of 2.7%. The max return would be that 3.2% we discussed if the stock was trading above 22 at expiration. Not looking likely to happen now, 2 days away. But if we converted it to a covered call, ended up buying shares of stock for the cost basis of $21.54. That includes the 22 strike and our 70 premium there and the commission, I think. Buy to close there and then sell to close the call. That would take into account that, that $1.27, I'm sorry. And the original premium received, we'd have that return of 5.9% as a covered call trade if the stock stayed above it. So we converted from a 2.7% loss right now, unrealized loss on a weekly series, to a potential 5.9% gain using standard November cycle. Okay. Well, that's just some of the rollout opportunities that were shown. Let's go back to the portfolio here. If I didn't like these ideas, I want to see what the put would look like if I rolled it to the next October series rather than going out to November, assuming I got put the stock. What if I wanted to roll it beforehand? Well, it didn't pull up the opportunities for us, but we can do that manually. Let me go ahead and close that. Let's go back to our portfolio. So once you look in the position analysis, if you didn't see a rollout opportunity that you liked in any strategy, whether you're not even using weeklies, just any strategy, what I could do is simply go to the profit and loss chart. All right, and this shows us our standard position, the graphic interpretation. There's our 3.3% potential gain. It's not showing us our current liquidation loss. We knew our max return was $70, the premium we received for this cash secured put sold on October 4th. Now I scroll up, and it does show me here's my weekly put, sold for 70 cents, one contract. But I want to see what would happen if I rolled, the stock's at $20.97 now, what happened if I bought to close this put and sold the 1 week out standard expiration October 20 strike put, or maybe the 21 strike put. Let's take a look. So I'm going to go into View Options. First, I have to go to the October weekly. Why? Well, it shows me the 22 put has been added. Well, I want to simulate selling. I have to click on that again. It's already been added, but I can click on it again. It adds to the next field, so I'm going to simulate buying. I have to buy to close this, and we'll just use the natural ask price of 127. So what would that look like if I did buy to close that, and then let's do the right at the money, the October 21. Still might get put the stock, but the stock's at $20.97, so let's take the next week out, standard expiration, 21 strike put. Okay, so what did I do? I sold to open the initial 22 put for 70 cents. I'm going to buy to close that 22 put. It's going to put in the natural ask price of $1.27 when I click submit. And I'm going to sell an October 21 put, and I'm just going to use the natural bid price on that. When I click submit, it's going to fill it in for me. It's $1.02. So hey, that's not too bad. We could roll down. We have a loss, remember, of 2.7% if we liquidated right now. A potential loss, unrealized loss of 1.5% if the stock stayed at $20.97. However, if we roll down, just did it manually, if I roll down and out to the next weekly series, which happens to be the standard expiration, but it's the next weekly series available, buy to close our 22 put, sell to open the 21 put, we could still realize a 2.2% yield. That's not too bad for technically now 14 days of trading if the stock's trading right above $21 per share. Okay, so a little bit of a repair here, a little bit of flexibility. Hey, if I wanted more, I could decide, all right, maybe I want to go out to the November series, make this a little bit longer. We saw some of those opportunities with the covered call. What happens if I just wanted to roll to the October 20, sorry, let me get on track here, the November 20 put. We'll simulate that. We cleared out the October standard expiration. Now we're going to simulate selling the November against our weekly position, trying to repair our weekly position. Let's submit that. So now for roughly 40 days out in time, it could be a 6.9% yield. So we lost 57 cents here, but we're going to collect another $1.86. So that would put our net premium here at $1.29, which is 6.9% of the potential 20-point margin requirement, $20 margin requirement. Okay, so that's just what we're looking at there, and we want the stock again to be above 20, but that's the flexibility. When we're doing the weekly options, as we get closer to the expiration, we'll have that next series available that's 7 days out to evaluate rollout opportunities, or we can go further out. We could go to the November series or maybe the December series. We have a lot of opportunities, more so than we would with just trading a standard expiration. All right, well, that's just our brief introduction, our brief summary of using the PowerOptions tools for weekly options. We went about 20 minutes over, but that's okay. We did record this presentation. It will be posted potentially later on this afternoon. If you think of any questions later on about this presentation or about weekly options, contact us at any time. You can send me an email. Send it to support@poweropt.com. It's poweropt.com. You can call us toll-free during market hours if you live inside the continental U.S. It's 877-992-7971. If you live outside the continental U.S., you can, of course, reach us at 302-992-7971. Of course, there's contact links at the bottom of every Power Options page. Well, ladies and gentlemen, thank you for joining me this afternoon. I hope you all have a great rest of your day and a great trading week. And, of course, we'll see you online tomorrow at 12 noon. We're hosting the Introduction to Radioactive Trading presentation. I should say Kurt Frankenberg's going to host those. And next week we'll be back with another Introduction to Power Options presentation. And next Friday, of course, after expiration, we'll have the open forum, open discussion Friday at 4:30 p.m. Thank you again, everyone. Take care. Good night.